Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. It's been a pretty torrid run lately for cryptocurrencies. It seems everyone has a view on the digital units, from the die-hard investors who might be feeling a little worse for wear right now, to the skeptics who aren't quite sure where the value comes from. But it's always worth listening when the big asset managers speak up, especially when they're calling cryptocurrency portfolio kryptonite. PGIM is one of the top 10 largest asset managers in the world, with more than $1.5 trillion in assets under management. Shehriyar Antia is Vice President, Head of Thematic Research at PGIM, and joins me this morning from New York. Shehriyar, welcome back to Fear and Greed.
Great to be back, Sean. Thank you so much.
So, portfolio kryptonite. Why the description?
Well, to put it simply, Sean, crypto really has no place in an investment portfolio. And, this was just as true when Bitcoin was at $60,000 as it is today. When an investor considers adding a new asset class, well, that new asset class has to offer a portfolio something new. And what I mean by that, is it an inflation hedge? Are its returns highly uncorrelated? Does it offer extraordinary risk-adjusted returns? Sean, in our research, we analyzed this growing investment mythology really around Bitcoin, and we found very, very little evidence Bitcoin has any of these investment superpowers. It simply does not offer investors anything new. Where it does stand out from other asset classes, however, is in its extraordinary volatility. We often forget, for example, that early last year, Bitcoin crashed and lost half its value then as well. So it's quite clear cryptocurrencies are really not ready for prime time investing. And it's unclear to me if it ever gets there.
Okay. So can we just go through some of these? I mean, the idea that crypto is like a currency or an alternate for a currency. And certainly there was a time there last year where people were saying crypto was an inflation hedge. I didn't quite get that one at all. I'm not even quite sure I get the currency one, but it's not a currency, is it?
So, when you think of what are some basic functions that a currency has to do, it has to be a relatively stable store of value. You certainly can't say that about Bitcoin. It has to be a unit of account, meaning that things have to be priced in it. There are outside of the deep digital realm, really nothing is actually priced in cryptocurrencies, be it Bitcoin or Ethereum. I can't buy when I go to get a haircut, when I go to buy a hamburger, they're not priced in Bitcoin. The other function of a currency is that it has to be a medium of exchange. And, there are some merchants, some high-profile merchants like Tesla, for example, who at one point was accepting Bitcoin as payment. But, curiously, and I think tellingly, they were pricing it in dollars, and you were paying merely the Bitcoin equivalent of it in dollars. So when you look at it from a clear-eyed economic perspective, Bitcoin really falls short as a currency because it just doesn't meet the basic functions of a currency.
And it's certainly not a hedge against inflation. We've learned that with rates rising, and it's certainly not a safe haven for investors either.
Absolutely. When you take a look at inflation broadly, right, global inflation has really increased over the last 18 months. And, cryptocurrencies have sort of yo-yoed and fallen off sharply. So that does not suggest a strong characteristic of an inflation hedge. And, when you talk about portfolio diversifier, Bitcoin, Ethereum, their returns are highly correlated with equity markets, especially tech stocks such as the NASDAQ, and also commodities. So when you really try and cut through the sort of, all of the optimism, all of the techno-optimism, when you really cut through the investment mythology, Sean, there really isn't much there. And, Bitcoin really doesn't offer investors much of anything new.
Okay. Is there a role, though, for digital currencies, maybe not private sector digital currency, but central bank digital currencies?
Certainly. So, when it comes to central bank digital currency, there's certainly a lot of talk about them, and there's a lot of news reporting about them. I think that there are two key points here to make about CBDCs. First, they represent a real threat to many cryptocurrencies, especially stable coins. Why? Well, they offer a superior trade-off to them. Central bank digital currencies offer the benefits of a digital currency with much less price volatility, just like stable coins, but without the risks around lax transparency, limited regulation, oversight. And in the last month or so, we have seen that those risks around stable coins are not merely hypothetical. Second, CBDCs are not some, way off in the future, distant possibility. The PBOC, the People's Bank of China, for example, has already launched the digital yuan. Every major central bank has plans to implement one. Talking about the Bank of India, the ECB, Bank of Canada, the Banco Central do Brasil, are all actively planning to implement a central bank issued digital currency, in the next year or so.
Stay with me, Shehriyar. We'll be back in a minute. I'm speaking to Shehriyar Antia, Vice President, Head of Thematic Research at PGIM. Okay, so the other part is the energy used for digital units, and this can be central bank digital units as well. Is that going to, when I think about it, there's so much energy needed to run the system, the technology behind it. Is that a problem, even for digital units from central banks?
Well, so when it comes to energy usage for a digital currency or for a cryptocurrency, what it really comes down to is the methodology, the way that particular digital asset validates and verifies. And there are basically, to put it simply, there are two ways of doing so. One is a proof of work methodology, and Bitcoin employs that. And it is extremely energy intensive, and it makes investing in Bitcoin directly, highly problematic from an ESG perspective and from a sustainability perspective. There is, of course, another way to sort of validate and confirm transactions, and that's a proof of stake mechanism. And currently Ethereum is trying to shift from a proof of work mechanism to a proof of stake mechanism.
Right.
But it's proving very, very challenging. It's proving very, very difficult for them. It was supposed to launch at the beginning of this year. They run into some technical challenges, and it's being put off. It's being delayed. My intuition and my guess is that central bank digital currencies, for the most part, going forward, will opt for the proof of stake validation mechanism, the one that's less energy intensive. But Bitcoin is really optimized for decentralization and anonymity and security, and it has no plans to change its validation mechanism. So it'll likely be a high intensity energy endeavor for a long, long time.
So, Shehriyar, do you think that this, we'll look back at this period of Bitcoins and Ether, of digital currencies, non-central bank digital currencies, and think that was just a bubble, that was just a phase? And I suppose I'm asking, where will they end up in 10 years? Will we have them in 10 years?
That's a great question, Sean. In its current state, it's really hard to see crypto evolving into a major asset class. It's really hard to see it evolving into a real, legitimate, useful, relevant payment mechanism as well. So while I'm still really optimistic about blockchain technology and distributed ledger technology, I'm not optimistic about crypto as an investment or as a currency going forward. Let me tell you why a little bit. So, in the past, right, Bitcoin prices have fallen sharply. They've rebounded sharply. There really wasn't much, collateral damage, and every rebound seemed to draw in new investors. It seemed to inspire greater confidence, greater optimism. But, with this current episode, with this current crash, there's something different about this episode. This one is way more existential, I guess. Here we're seeing, seismic shocks that are creating a lot of collateral damage, and these hidden cracks and vulnerabilities in the broader crypto ecosystem are no longer hypothetical. What's unfolding right now, Sean, to me, really resembles the financial crisis of 2008. And what do I mean by this? So yes, there's been, trillions of dollars of wealth wiped out in the last 8-10 months. But more importantly, in this crash, we've seen the spectacular demise of one of the largest stable coins. We've seen some of the largest foundational players. I'm talking about the exchanges, the lending and staking platforms, essentially tell investors, sorry, you can't get your money out right now. This is classic systemic failure. Take it from a former central banker. We've seen this horror movie before, and now it's playing out in crypto. Now, looking forward, I don't think Bitcoin and Ethereum are going to vanish from the earth altogether. But I don't think investors will gain confidence and optimism from this downturn as they have from prior ones. There's always going to be some ardent supporters of Bitcoin and some folks that are very, very focused on DeFi, and it'll likely remain a marginal asset class going forward, I think.
What I always think, when I think about digital currencies, and certainly Bitcoins and Ethereum have got big supporters, what I always find amazing is there's something like 10,000 digital currency, or so-called digital currencies out there. It's kind of ridiculous.
Yeah.
Amazing. Shehriyar, thank you very much for talking to Fear and Greed.
Thank you very much for having me, Sean. Have a great day.
That was Shehriyar Antia, Vice President, Head of Thematic Research at PGIM. This is the Fear and Greed Daily Interview. Remember, you should get professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.